The real estate select sector index is up over 7% today on lower than expected inflation data. Rising rates have hit real estate and home builder stocks hard. But to understand where we're going from here, we need some perspective. And that's what we hope to provide today on Open Interest. Ten-year rates are up 3.3% from the August 2020 lows. 30-year mortgage rates are up roughly 4.4% since February of 2021. As we would expect, this has profound impacts for affordability of real estate, particularly when we couple the rate increase with the sharp increase in real estate prices we saw during the pandemic. The median home price in January 2020 was $327,000, according to the St. Louis Fed, and that number was $454,900 in the third quarter of this year, a nearly 40% increase in just over 2.5 years. How sustainable are these prices, and what are the implications? To delve into that more deeply, I'm joined once again by my good friend, finance professor at Rutgers, Mark Guthner, who's going to walk us through some of the implications. How are you, Mark?
I'm great, Mike. How are you?
I'm well, thanks. And of course, taking a look at today's price action in equities, but in real estate and the home builders in particular, we're seeing this really big rally. And I think a lot of people are thinking that maybe the Fed's rate hikes are coming to an end and that somehow that is going to provide a tailwind for real estate and home builders. But it seems to me that we're still pretty close to the highs, not to the lows in many cases where real estate prices are concerned. And you have some slides to walk us through that, don't you?
Yeah, I'd like to get some perspective on how much it costs people to own and buy a house. And I think that tells a nice story about what might be going on. So why don't we run up to the first slide and we'll just talk about, hey, what does it cost to buy a home? So I chose $1 million here because it's a nice round number to work from. I realize that in some parts of the country, New York City, and $1 million buys you a one-bedroom apartment. Other parts of the country, it provides you with a McMansion. But I'd like to work with this as a baseline. So to make the numbers really simple, I'm going to say I'm going to go buy a house for $1 million, and I'm going to have 100% financing. So I'm going to put nothing down, and I'm going to lock in my rates for 30 years with a 30-year mortgage. Now, I'm doing this example pre-COVID. So this is when the interest rates were down super low. So you could get a mortgage rate, as hard as it is to believe, for about 2.5%. So if we run that through our calculator, the monthly payment for that is going to be $3,950. Of that payment, just shy of $2,100 will be interest, and almost $2,000 will be principal. And this is kind of an interesting thing. You buy the house, immediately you're paying yourself back right away with a big principal payment, and the interest not so much. So let's walk on to the next slide and take a look what's happened to rates. And I think one of the things that you can draw from this, and this is rates going back about 30 years, 40 years. Interest rates were in falling mode. And there were, yes, of course, some times when there were a little spike up in rates, but the trend was clearly down. And that trend is broken. If we don't have a trend line in there, but if you could put one in the mind's eye, you can see that where we are now with interest rates on more 30-year mortgages of about 7.5%, that downtrend is decisively broken. And so I think the world has changed. And that'll have implications for all kinds of asset prices. And we're talking about real estate here today, particularly home prices and what it's going to cost for people to afford the home of their dreams. So let's walk on and take a look at what the price of this house would be, or the monthly payment. If rates went from the 2.5% that existed, I guess, what was that, a year ago, 15 months ago, to 6.8% when I bid up these slides. So the payment, as we saw before, was just shy of $4,000 a month. And look where we are today. We're up over that same house, $6,500. We're getting the exact same house. There's not an extra bedroom, not a bigger backyard. We're not getting a swimming pool. We're just paying more money for the exact same thing. But there's something even beyond that that's, I think, a little bit more damaging than most people would think about. The payment does go from about $4,000 to about $6,500 a month. But take a look at what happens to interest. Interest goes up 172%, reflecting the fact that interest rates rose that same amount. But take a look at the principal. You're now paying your house back at a much slower rate, whereas your monthly payment would put $1,867 back in your pocket as equity in your property. You're only getting $853 now. So price of real estate and the cost of that payment is really substantially higher. So another way one might want to think about this is, let's say, people buy a house based on the monthly payment. That's really common. People will say, hey, I did my budget. I can give X dollars to my mortgage payment in terms of principal and interest. So what happens to the value of a house that somebody could buy if they needed to keep their payment the same at $3,950? Sorry to say, you could only afford a house that's about 40% less than that $1 million house. Again, you still have that same issue. You're going to pay a lot more in interest, and a very small bit of your monthly payment will be principal. So that house is more expensive from that standpoint. You're not paying yourself back. And that's troublesome. You think about if you're a person who bought a house, and listen, if you're going to live in that house for 10 years, 15 years, 20 years, you've locked in a low payment, you're good to go. Live your life as it is. But what happens if you get a job opportunity in another city or state, which would be great to have? You would have to sell your house. And who are you going to sell your house to? You're going to sell it to somebody who's got to pay this higher 6.8% mortgage rate. And that's troublesome. So you're going to have to discount your house if you're going to sell it. And that's going to hurt if you got to do that. And you're going to have to take a discount. Now, are you going to have to take a 40% discount? Not likely. But you're going to have to take some kind of loss in your house, and that's no fun. And we can see that the marketplace right now is starting to reflect that. So here we have the Case-Shiller price index going back quite a few years, and we can see that the all city index, and this is an index of homes in big cities, is up about 25% since COVID low. So, but we see just a few months ago it peaked, and now it's starting to fall back down. So this is an interesting thing, a challenge for us to deal with.
So. Yeah, it's interesting as we take a look at that, and I think I hear your phone ringing in the background.
Yes,
somebody urgently trying to get in touch with you.
Yeah, sorry. Let's just.
But what I was going to say is that actually the 30-year mortgage rate has actually risen some even since you put that together. I think we're up near 7.25 most recently. That's as of yesterday. I think the mean 30-year mortgage rate was about 7.25. So it's almost doubling the payment, isn't it? At that rate, I think, in round numbers.
It is. It is. And so if you were having trouble getting into a house before, you're really going to have trouble getting into a house now.
Yeah, and what is also interesting to me is that a big portion of the 40% increase in the median home price that we've seen in the United States was fueled by a combination of things. One of them was obviously we had some inflationary pressures in general. Secondly, we had extraordinarily low mortgage rates. So we were coming off of a relatively low era of mortgage rates, in the 4 to 5% range, probably before the pandemic, into that sub-3 realm. It seems hard for me to imagine that those gains in home prices are truly sustainable. But as you point out, it's likely that a lot of people are simply just not going to sell because they have a payment that they can tolerate at the moment, and they have no real way to migrate from a house that they're in to another, given the change in rates, because you can't carry the mortgage on the asset from one house to another. Have we ever seen a drop in real estate prices as profound as these increases in rates would suggest we should see?
Well, we saw obviously a slaughtering in housing prices in 2008, 2009, when prices of houses in many places went down 40 and 50%. So we could see another, substantial drop in housing prices. I'm not looking for numbers as big as what we saw in 2008 and 9, but 20%, 25%, it seems to be is not out of the question. Or maybe just giving back the COVID boost, if you will, and getting back on the longer term trend.
Yeah, so giving back the COVID boost, still, even if we gave back all of the COVID boost, homes would be less affordable today than they have been for several years because of these increases in rates. And I think that problem is compounded a little bit by the fact that we've seen increased costs in many other aspects of, personal and family household budgets. So if you're spending more money on gasoline, if you're spending more on heat, if you're spending more on food, then the amount of one's income that is available to make payments as a percentage of your total income is also going to decline if your income has not increased at the pace of inflation, which we know is generally the case. So it seems to me that we would have to think that at least the COVID boost, if we'll call it that, the pandemic pop in real estate prices that we've seen, would have to reverse at least. I mean, the big difference, of course, between our current housing market and the one that we saw in 2008, that housing bubble, is I think there was less speculation this time around, excluding purchases being made by the Zillows and Redfins, who were also speculating. Private equity, of course, was buying a lot as well. But outside of that, I think there was less personal speculation in the real estate market, not a lot of people taking liar's loans and doing house flipping. But still, that would suggest there's a lot of further weakness. So I guess my follow-on question then, if we are thinking about the equity markets, would you then be inclined to fade the sharp rally that we've seen in real estate-related stocks today? So that would include the home builders, that would include Zillow and Redfin, both which saw really big pops today. In the case of Redfin, which is short sale restricted, I believe, there's a very substantial short interest there. I wouldn't initiate a short in that one because you could be subject to some sharp bear market rallies. But it does seem to me that maybe some of the pops that we've seen today aren't justified when we look at the numbers sort of taking a step back. Would you agree with that?
I do. Hope springs eternal, of course. And I think there's probably a lot of people that were short the stocks, and we're seeing a good old-fashioned short squeeze as people flee those short positions in their bearish bets on those stocks. I think the home builders are going to have a harder time making money because if you think about how they go about building a house and pricing a house, is they look at what the market price of houses are. they subtract off the cost of building the house, an amount that they want to make for profit, and then that leftover number is what they are willing to pay for land. So they've just bought a lot of land in a world, pricing it in a world in which housing prices are higher than I think they're going to be. So they're going to have a harder time making money in the next few years. And they're a typical cyclical stock where the PE ratios of these stocks are the lowest when their prices are at the highest. And that's something to that's hard to get your arms around. So yes, looking backwards earnings, these companies trade at high single-digit PE ratios, and that number I think is going to rise quite a bit as the E goes away. Even as the P goes down, I think the E is going to go down even faster. And so by the time this is all over, it'll be the exact opposite. They'll look, from a PE ratio standpoint, they'll look expensive. Maybe they'll have a 25 PE ratio. And then, of course, then that's going to be the time to buy. It's counterintuitive, but that's the way you trade the big cyclicals.
That brings me to my next question, which is a little bit broader than just real estate. But I think a lot of people have been asking themselves, is the bear market in equities over? Now, we've had a huge shakeout this week in news. Now, obviously, this inflation news is creating a huge boost for equities today. We had some other very interesting news coming out of FTX and Alameda Research and what's going on in the crypto space. But my question is, it looks to me like the downtrend in the S&P, the upper level of the downtrend that we've been in this year, is around 4,100 or so in the S&P. And we basically had two unfilled gaps in the S&P. On the upside, that would take us to about 4,100. On the downside, to about 3,300. My thinking here is that we still remain in a bear market. And is it possible that we go to the upper end of that downtrend channel, which is 4,100? Of course it is. And today's move certainly helps. I'm not exactly sure what we're up in the S&P, but it was 150 handles, more than that today. It's one of the sharpest up moves I've ever seen, actually. But I don't think that this signals the all clear for equities just yet, because a lot of the implications that you're talking about for real estate similarly apply to equities, don't they?
Yes, they do. But before I go on with that, I'm impressed that you've put on your technician's hat, and Carter's going to be proud of you. But I don't think that the bear market is over. It's going to be sort of a two-step process. The first hitting of prices as a result of higher interest rates, right? So the present value of the future stream of cash flows derived from a corporation falls in value when interest rates go up, just like the value of a bond goes down when interest rates go up. So that's sort of the first step. And I think the second step is when we're going to start to see cash flows and earnings of corporations start to fall, for some of the reasons that you mentioned earlier in the talk, and that is people are having a harder time. The inflation is really hurting. People are spending more for gas or more for food. Electricity is going up. Lots of things are going up in price, and that means less disposable income, and it's just going to be that much more. So people are going to cut back. Corporations are going to sell less stuff. And you think about where the leadership was. The leadership was all in tech. And what have we seen the last couple of weeks? Tech companies are now laying off people hand over fist. And that tells us a little bit more of what's going to happen down the road. Their revenues are not growing as they expected. Some companies just made a big mistake, like Facebook/Meta. The Meta universe is not turning out to be what the company hoped it would be. They spent egads of money trying to build that online universe, something in the matrix, if you will. And nobody's going to show up, or nobody is showing up. And so they've got to retool and pivot and take their business someplace else. And so I think that a lot of the tech companies are just going to have some trouble in the months ahead. Hey, listen, they had it great for a few years. Everybody built nice home offices, bought a lot of tech equipment, cameras, lights. So a lot of demand was pulled forward. And so now we're paying the price on the back end of that.
Yeah, so we hate to be doom and gloom all the time. It feels certainly over the course of the last several months when we've done these videos that we haven't had a lot of great things to say. And I would love nothing better than to signal the all clear and suggest that the worst of it's behind us. But I'm with you. I don't think that it is just yet. I still think we have a lot of indigestion that's going to have to come for everything that we've done over the course of the last couple of years. With that, thank you very much, Mark, once again for joining me. And for those of you watching, thank you for your time and attention. And if you like this kind of content, please hit the subscribe button, hit the notification bell. Please be sure to comment. We will try to answer them. And we'll see you in the next one.